Hello and welcome to our discussion on accounting. The focus of this particular presentation is to understand one of the important concepts of accounting called accrual concept of accounting. When we say accrual concept of accounting, some questions normally come to mind. What is accounting accrual concept? Why? And what is the relevance of this accrual concept? How this accrual concept affects the financial statements and accounting equation. So in this session, besides understanding what, why and how of accrual concept, we'll take an example to understand the accrual concept's effect on accounting equation and accrual concept's effect on the financial statements. Before we do that, let us take an example. Suppose X Limited purchased goods worth of 20,000 on 1st April and on credit, but the money payable is on 1st June. So the question is, when should X Limited recognize this transaction of 20,000? On 1st April or on 1st June? 1st April is the date of transaction. 1st June is the date when cash is paid for that transaction. Similarly, in this case, X Limited purchased goods of 20,000 on 1st April for cash. So here the date of payment and date of transaction are same. This is for expenses. Similar can happen with the incomes also. If Z Limited sold goods worth of 60,000 on 1st April on credit and money receivable on 1st August, so the question is, when should Z Limited recognize this transaction, on 1st April or on 1st August? Whereas if it is for cash, you don't have that problem of confusion whether to recognize on the date of transaction or on the date of actual receipt of cash or actual payment of expenses. So in this type of situation, the question is, what is the point of recognition or recording a transaction? And that is where the accrual concept comes into picture. The accrual concept is actually a concept of recognizing a transaction. According to the accrual concept, expenses are recognized when the expenses occur, not when the cash is paid. That means, in this case, when goods are purchased on 20,000, so on 1st April, I recognize the transaction on 1st April, not on 1st June. 1st June, actual cash comes into picture. Similarly, all incomes or revenues are reported or recognized when they are earned, not when the cash is received. So therefore, in this example, when Z Limited sold goods worth of 60,000 on 1st April, they have to recognize the income on 60,000. So accrual concept therefore says all expenses should be recorded at the time of happening of the event, not at the time of actual payment. All incomes should be recorded at the time when the transaction happens, not when the actual cash is received. Now this is a very, very important concept which affects the corporate accounting, and because of this, the determination of profit to a large extent depends on the accrual concept. Let us take, so why do you like to record this transaction on accrual basis? That means why? The accrual concept is followed to enable a firm to determine the profit and loss for a particular period. Normally, in a business life, we determine profit for a particular period. The period may be a month or a week or a quarter or a half a year or a year. those statutorily companies are required to determine the profits for a year or half a year. So for the determination of profit, we use accrual concept. So accrual concept is important because the profit is an accrual concept. Whether paid or not paid, whether received or not received, incomes are and expenses are recorded and recognized for the period. Let us take an example to understand that. Let me first explain through an accounting equation. We know that accounting equations shows the sources and assets. Suppose on 1st April, our sources are capital represented by the corresponding assets cash. And you can see the transactions are for the month of April. So every time this transaction happens, the accounting equation changes. First transaction is purchase goods for cash. As a result, cash will reduce to the extent of 10,000 and stock is increased or inventory gets into my accounting equation as a creation of an asset. No change in the capital, and as a result the source is equal to assets. You can see that sources are 100,000, assets are 100,000. But here there is the problem of accrual concept is not there because you have recorded the transaction at the time of happening of an event, and at the time of happening of event you also paid cash. But see, in this case, on 12th April, goods are purchased on credit. Should I recognize this at this moment? Answer is yes, because accrual concept. But what happens because of the accrual concept? The goods increases from 10,000 to 60,000. But did you pay money for that? No. There is no change in the payment of because you have not paid anything, there is no change in cash. Is there any change in capital? No change in capital. But how did you acquire this inventory? Acquisition of inventory resulted in creation of a liability, and that liability is called creditors. So you can see the effect of the accrual concept. The accrual concept results into creation of a liability. So therefore, in this case, I recognize the transaction when cash is paid. In this case, we recognize the transaction even if cash is not paid. Let us see for the income. We sold goods, 50% of the goods for cash, 80,000. So what happens to cash? Cash goes up by 80,000. And inventory reduces by 30,000. No change in capital, no change in creditor, but you made a profit of the excess of selling price on the cost. So therefore, on 20th, we recognize an income because goods have been sold for cash. Change in cash and also change in inventory resulted in profit. But observe on 25th April, what is happening on 25th April? You sold balance goods for credit, 95,000. The company sold the balance 30,000 worth of inventory for 95. So therefore, inventory becomes zero. But did we get this cash? Did the company get this 95,000? No. But should the company recognize it? Yes, because of accrual concept. But because you're going to receive later, because the company is going to receive that money later, we create an asset to that extent called debtor, okay, and or receivable, okay. So inventory becomes 0, debtors become 95,000. Debtor is an asset because you're going to receive, the company is going to receive cash 95,000. Is there any change in cash? No change in cash. Is there any change in capital of the company? No change in the capital. Is there any change in the creditors because of this transaction? No change in. But profit goes up because you sold the balance goods at 95,000. So you made a profit, additional profit of 65,000 based on these transactions. Now you see these salary paid. What happened? This is an expense for the month of April, right? This is an expense for the month of April. And because it's an expense for the month of April, the company has to recognize it. And did the company pay cash? Yes. So therefore cash comes down. No change in the inventory. No change in the debtors. No change in capital. No change in creditor. But the profit goes down by 5,000 because there is an expense of 5,000 salary. But did you pay that salary? No, the company did not pay this. The company paid the salary. So therefore, it's a transaction where cash has also gone out. But compare this with the next transaction. This rent for the month of April, 10,000 is for the month of April. But did the company pay that? No. But even if it is not paid, the company is bound to recognize that because of the accrual concept. So if you recognize that as an expense, what will happen to the profit? The profit will reduce by 10,000. Did you pay cash to that extent? No, we have not paid cash. So what happened here? So an expense has been incurred, but you have not paid cash, but you are recognizing that. So you have to create a liability called rent payable, which is 10,000. So let me explain that once again. So in this case, an expense has happened, so you have reduced the profit. Did you pay money? Did the company pay money? No. But will they pay money later? Yes. Because they have to pay money later, that is a liability. Is there any change in creditor from for whom we purchase goods on credit? No change in creditor. No change in capital. No change in inventory. And no change in debtors. Right? So what did we see here? So the company is undertaking transactions which are for cash as well as for credit. But the accounting principle says a company is bound to recognize the transaction as and when the transaction happens. So therefore, both cash and credit transactions are to be recorded. So the accrual concept results in creation of assets and creation of liabilities, even if you have not paid money or you have not received money. So the accrual concept can be captured through accounting equation. But we can also see the same transactions through the financial statements. Observe this, I've taken the same transaction for the same company. Now instead of accounting equation, I'm showing that now the financial statements of that company. So the opening equation, which is 100,000, 100,000, the financial statements are the balance sheet, income statement and cash flow. For the focus, let us start with opening balance sheet. So the opening on 1st April, the balance sheet was 100,000 capital, cash 100,000. And then we'll see what happens to these transactions. When the company purchased goods for cash, okay, when the company purchased goods for cash, so what happens? Cash reduces, right? And to that extent, an asset called goods will, so there is a cash, there is a payment to the extent of goods, okay, that is inventory. I purchase the inventory and inventory is 10,000, and inventory is an asset. Inventory is an asset. I show that as an asset. So at this point of time, there is no expense, there is no income, but just an inventory to the extent of 10,000. So next transaction on 12th April, but unlike the accounting equation, we are not balancing the balance sheet after every transaction. Okay, that's the difference. Purchase goods on credit. So when you purchase the goods on credit, inventory will increase by 50,000. Is it okay? But did you make payment for that? No payment. But there will be a creditor, which is creation of liability. Why did the liability come into picture? Because you purchase goods on credit, and because you have to recognize that, the company has to recognize that because of accrual concept. Now, sold goods for cash 80,000. So there is a sales 80,000. Is for cash or credit? Of course it is for cash. So therefore I received cash and there is an income. And whenever there is an income, according to another important concept, which is called matching concept, which we may see in detail in other presentation, there has to be cost of goods sold, and the cost of goods sold is 30,000. What is that? 50% of the goods have been sold for 80,000. As a result, the inventory will come down by 30,000. Now sold balanced goods. How much balanced goods? 30,000. And you sold that goods for 95,000. Okay, so once again there is a sales of 95,000. Did you receive cash for that? Did the company receive cash? No. However, if the company has sold goods on credit, if it has to recognize that as a sales or an income, the company will receive that money later. Any money receivable in the future is an asset for the company. So let me just highlight these two. I'll come back to that at the end. Creditors and the debtors. Okay, so creditors and debtors are the result of the accrual concept principle. And what is the cost of goods sold of the balanced goods? 30,000. So what happens to the inventory? Inventory becomes 0. Okay, sold balanced goods for 95,000. So therefore, cash received is recorded. Cash not received, income not received is recorded because of accrual. The goods purchased for cash is recorded. Goods purchased on credit is also recorded because of accrual concept. Paid salaries. So therefore is a payment. I'm going to pay that 5,000. Why did you pay? Why did the company pay it? Because it is an expense for the period, and so 5,000 is an expense and a payment. But what happens to the rent? Rent has due but not paid. Should I record it? Answer is of course yes, because of accrual concept. So the rent will be shown as an expense, but I'm not paying any rent here because it is due but not paid. But if an expense due but not paid, I'm going to have a liability called rent payable. Okay, rent payable, which is 10,000. So let me highlight even this. So what did we see here? So the creditor, rent payable, debtors are appearing on the balance sheet because of accrual concept. So accrual concept, because of the recognition principle, on a particular date, the company will exactly know how much is receivable, how much is payable. So it is a true reflection accurate reflection of the business. All transactions done. So let us find profit. Profit is income minus expenses. So profit is 100,000, and profit, if no information given, I would like to retain, the company will retain the profit. It will be shown on the balance sheet. What happened to the cash? Cash available is 180,000, and cash payable, payments during the period is 15,000. So cash in hand is 100. So two important items on the balance sheet, cash in hand and profit for the period, comes from the income statement and cash flow. This also shows the interrelationship between the financial statement, balance sheet, income statement, cash flow, which we will see a bit more later. The focus of this session, as I mentioned, is accrual. So the creditors, rent payable, debtors are the direct result of the accrual concept. So as a result, because of accrual concept, I know this is a profit. The company's profit for the month of April is 100,000. Did the company receive entire income? No. Did the company paid all the expenses? No. Even if they have not paid, even if they have not received, the accounting says recognize that. So to summarize, therefore, accrual concept is a recognition principle, which says all expenses, all incomes, all transactions should be recognized at the time of happening of an event, independent of the fact whether it is for cash, that means, or on credit, cash received or not received, cash paid or not paid. As a result of this, we create assets and liability for the money payable and money receivable. Thank you very much.